Hey guys, thank you for joining me for this week's Tax Rep Network podcast. I have a very special guest because we're doing a very special program. Jason Freeman, a friend of mine who was on when we did the community property discussion, is joining me. We had just done a webinar on the New York Times article that came out about Mr. Trump's, the president's taxes, and thought it would make a great podcast. So hopefully you'll enjoy it. We just want to discuss as dispassionately as possible, leaving politics out of it, the issues that were raised in the article. So if you haven't read the article, I will put a link down below. Okay, so you can go check that out. If you're interested in contacting Jason, go to freemanlaw.com. I'll put his email down below if you want to get in touch with him, if you need anything or your clients need anything. All right. Couple other big things I just want to tell you about before we get into the podcast. The New England IRS Representation Conference, it's the 7th year. Okay, it is 2 full days this year, 16 credits, 15 tax, 1 ethics. We have about 14 IRS executives joining us, including the Chief of Appeals, Chief of Criminal, Chief Counsel Michael Desmond is joining us. Commissioner Eric Hilton for Small Business Self-Employed Division is joining us. Lee Martin, who's the director of the whistleblower program, is joining us. All right. There is some rumors that Chuck Reddick, our commissioner, might be stopping by to give us a keynote. All right. We'll let you know when that actually is nailed down. A lot of cool stuff. Go to the link below, IRSrepconference.com. All right. The early bird is still going on, and hopefully we'll see you at this year's conference. Interested in building up your resolution practice, your representation practice, we're going to see a massive upswing in people in trouble, especially when the IRS starts going after people. The states have already started. If you're interested in building your representation practice and want help doing it, you want the resources, the checklists, sample letters, and to consult with us, as well as over 110 hours of training, go to taxrepllc.com. You can join up now, save $100 a month off 3 months by using the discount code TAXREPNOW. All right, all caps, all one word, TAXREPNOW. You knock $100 off a month for 3 months. Go to taxrepllc.com and we'll see you inside TaxRep. The other thing I want to talk to you about is our sponsors. We only have 2 because we only take sponsors that we use ourselves. Okay, how do you call and get through to the IRS in under 3 minutes? We use ENQ. Go to the description below and you'll see the link for Call ENQ. We have a special discount arranged for our tax rep followers. All right, you can get 200 minutes for $19.95. All right, so click on the link, try it out. You'll get through to the government in under 3 minutes, often in 30 seconds. All right, we are going to save at Green and Sklar's between $50,000 and $70,000 worth of time by using ENQ. It has literally changed the way we interact with the IRS, right? And we do this every day. So go check that out. And for those of you who want to know how we do our offers, how we get our transcripts, I talk to you about this intelligent ordering where every morning I see what has changed with my clients. It's tax help software. All right. It is the cornerstone of our practice. It's what we use, again, for pulling transcripts, tracking our cases, getting our offers and installment agreements done. And again, with intelligent ordering, I come in the morning and I see everything that has changed on my clients, even before the letters show up. All right. So go below, check out the link, taxhelpsoftware.com. If you want it, use Tax Rep Trial, all caps, one word. You can get a free 2-week trial. If you're interested in buying it, and it's not that much, it's like $500 a year or something like that, you can use Tax Rep 10, 10, Tax Rep 10. Again, all caps, one word. That'll knock 10% off the purchase price. So go check out Tax Rep LLC. Go check out Tax Help Software. And check out Call ENQ, and you will be off to the races. It's what we do here at Green and Sklar's. You will not be disappointed. All right. Thanks for listening in, and I hope you enjoyed this week's podcast. All right. So now, Jason, thank you for doing this. So just everyone listening, I'll if you don't mind, I'll give my 2 seconds on it. So Jason and I, along with Dan Mayo, just did a webinar talking about Trump's taxes, and we've tried to be as even-handed as possible. And then based on the feedback, you and I were talking about, this would make a great podcast. Let's do this on the podcast. So here we are. We're going to do it on the podcast. Meanwhile, interesting stuff. Since we did this, by the way, did you see the article in the Wall Street Journal about the retreat in Westchester County? New York State is now looking at that as part of its potential criminal case against the Trump family.
I did see that.
We hinted at it a little bit that, it could just be aggressive or whatever, but New York, I think, is looking at it as an affirmative act.
It's interesting. I saw that, and you get the feeling with the way that things came out of the New York Times article that really put this on the scene, almost a tome. I mean, it was the longest article I think I've probably seen in a periodical like that. That there are there's more to come, and more fallout. But you're right. This is one of these obviously very politically sensitive topics, and we took kind of every effort to be just as objective, present the facts, present the potential ramifications if these facts are true. And I'll just give it as the disclaimer to everyone out there. Look, we're coming at this from taking the facts that have been presented by the New York Times and their reporters based on the documents that they have represented to have reviewed. And we're taking that, and this is all we can do, right? We don't have another side of the story. Nobody's come forward with the other side. And so we have to take it as these are the facts. What are the potential consequences? What do these things mean? And what the hell, how do you interpret what's been put out there? And, look, we're what, 28 days out from perhaps the most consequential election, the country's ever had, arguably.
Yep.
And whichever side, whichever political side you fall on. And it's a very relevant time to be discussing something that many people in the country think is a very important topic.
Yeah, no, it will. So, what's interesting is, and what we'll talk about, there are tax issues that are raised by this. I think, by the way, I was just on Hector's podcast yesterday afternoon, and he took a different spin about what are the lessons to learn from this, and there are some. So I think that'll be interesting to talk about. And then there is, the New York Times, which, let's be honest, does have an axe to grind against the president. They clearly had their spin on it. All right. Although I think they did a very good job just laying out facts and numbers, there was I think a fairly clear slant that they thought a lot of this was nefarious, or at the very least, if not nefarious, that Mr. Trump had a real reason to not want to share this, because it doesn't put him in the light of a brilliant businessman. What it looks like is someone who basically is losing money and lurching from thing to thing to keep everything afloat. Whether you take that from it or not, that is what I took from the New York Times article. So if you're listening to this, first thing I would do is I'd go read the New York Times article. We can. I'm sure we'll put a link in the description below to it. I think that is time worth spending reading it. One, so you're not just listening to us, you can actually go read what the New York Times said. The other thing is they clearly have his tax returns. I mean, the numbers are very specific that they lay out. So it wasn't sort of like, got to look at it and this is sort of the gist. It is, no, here's the numbers, which was, I'm very curious how they got them.
That seems to be the question I think I've gotten more than any question about substantive tax treatment, any particular item outside of perhaps the haircut deductions, which you and I probably both agree is probably one of the least interesting issues from an actual tax perspective. But it's the question of how did they get these? what laws were broken in the process, if any. But how did they get these? The short answer to that is I don't think, we don't know. We can guess at the several avenues that may be possible. The representation from the Times in the article is, and I think this is, I think it's safe to say that any language in there along these lines is very carefully crafted and has been reviewed through the editorial channels and through the legal channels and whatnot. But it's something along the lines of they were obtained from persons with legal access to them, if I recall correctly.
So, just on that point, it's illegal for either the IRS or the states to share them. And in fact, it's illegal sometimes for them to even share with other law enforcement. So I don't believe that anyone within the IRS or the state would go and commit a crime by sharing them. Banks could potentially have had them, right, because of financing and whatnot. But most banks have their own rules about not sharing that without written permission from the taxpayer, from the borrower. I strongly suspect. So to me, the two obvious places would be from the accountants. Somebody at I think Mazars is the firm in New York that does his work, and that somebody from Mazars, disgruntled, who had access to them, shared them. I actually think it is much more likely that they came from within the Trump organization. I just, to me, I would put my money, if I had a bet, that it's either somebody within the Trump organization or it is somebody within the accounting firm. I'm not sure that his lawyers, like Michael Cohen, I don't know that Michael Cohen would have had them for 20 years. He wasn't. I don't believe he was involved in the financing deals. He was Trump's fixer. I'm not sure why he would have had 20 years of tax returns. So I'm sort of, because I've same thing. I've gotten it, and on social media said, "Do you think Michael Cohen turned them over?"
At this point,
first of all, it doesn't really matter who did. They somehow got them, but just as conversation, I don't know that Michael Cohen would have had them. I would have bet it would have been somebody in either in the organization or at the accounting firm. And what is interesting is there is some hints here that they have the depreciation schedules. If that's the case, that is an accountant's copy. Because as a tax lawyer, I actually came up through the accounting firms. I was at KPMG and Deloitte and went on my own, and people have heard my story on other podcasts. Generally speaking, the accountants for the client copy and government copy do not share the depreciation schedules. In fact, that's how you know you're losing your client, when they suddenly call and want the depreciation schedules. Why? Because the new accountants need them.
That's an interesting inference to draw from. Very interesting insight. And I think the same thing about Cohen. At this point, I think he's so openly hostile to Trump that I don't think, I think if anything, there might have been a willingness to say, and validate the documents if they came from Cohen, be my guess. I'll tell you, my thought on this has been these have possibly been a leak from either the Southern District of New York or grand jury investigation with the state of New York. Who knows? It's probably anybody's guess. That they did make some indications. I guess the Times did in some of their correspondence that this was not provided because of the risk that providing it would, I guess, tip off who the source was, and that always makes me question, are there some Bates labels or something that have been produced with it in response to a grand jury subpoena, something along those lines that might indicate where exactly it came from.
That is also interesting, because if it has a bait stamp on it, and it wouldn't take long to figure out which ordering that was in. That would tip off if it did come from a government investigation or the Southern District, or the New York prosecutors, the AG's office. So but regardless, wherever they came from, New York Times has them. So some of the issues that were raised, for those of you who have not read the article, the appropriateness of the deductions. You've heard about the haircuts and other stuff, but the haircuts makes a good headline, but there's actually much more interesting stuff in there. The audit that has been going on for 10 years, the potential conflicts of interest. And I call it potential because we don't necessarily know that there is or there isn't, but there's certainly potential for it, and I do want to address that. In fact, actually, that is the thing that I addressed at the very end of the webinar that I got the most hate mail over. That we had done a great job. Why did I have to bring that up? And my response was, the New York Times article raised it, and the webinar was to discuss the issues raised by the New York Times article. And finally, which kind of goes hand in hand with the potential conflict of interest, was this sort of gathering storm of the looming debt that he has coming due, north of $400 million in the next 4 years, plus if he has to repay that IRS refund. So, there's a lot going on, but I think just as background for those who don't know, the Trump organization as an umbrella actually consists of more than 500 entities. Virtually all of them are owned by Mr. Trump himself. Anyone who does any kind of tax planning, I imagine that most of these are probably single asset entities. I would think today mostly single member LLCs that would roll up onto one corporate return, which also allows you to take income against losses and other ones. 105 of them are a variation of the name Trump Marks, which is what he uses for all of his licensing deals. When he became president, he had all of these roll into a revocable trust. The idea being that he has, divested himself of this by putting it in a revocable trust. I really don't know that that's divesting, but I guess to the public, they would say, oh, well, he put it in normally you put it in a what's called a blind trust, where you have no access to it and you have no influence over it. A revocable trust to me basically means it's me. So I don't really buy that, but okay.
Yeah, there's probably a degree of plausible deniability in terms of what the revocable trust structure does. Now, I will say on the overall structure, 500 entities, certainly to your average American, that sounds very complex and a lot. But truth is, for someone like him invested in many, many projects and real estate, I don't think it's particularly surprising to us that you would have a structure like that. There are a number of legitimate reasons, and probably if you're advising somebody in this situation, you want to cabin off all of these projects and assets and liabilities. So nothing particularly surprising about the structure. You would expect that it's kind of a flow through entity structure that flows up ultimately. I agree with you. The revocable trust, frankly, not sure that truly does much. But that's the structure as we understand it.
Yeah, and just if you're listening and not really following, if to many of my smaller clients who are starting out, they don't want all these different LLCs because they have to file and pay a fee every year for there's a state LLC fee. When you're at Trump's level, the $250 or $500 a year or whatever doesn't mean anything. Although you could argue that's more in taxes than he actually paid in federal income tax, but we'll get there. The idea being is that you want these things, as Jason just said, cabined off, meaning that if there's a problem, if I fall and break my leg and I sue Trump Tower, potentially what's at risk are the assets in that entity. So if you have multiple assets in one entity, everything there is theoretically at risk for suit. So you do like to have these in their own entities. That way, what is at risk would only be that asset. The others would all be shielded from that. So a couple things the New York Times talked about. They talk about what the return showed. And again, most of the stuff made good headlines. That Mr. Trump has paid no income tax, federal income tax, in 10 of the last 15 years, although he has paid through the AMT. All right. The alternative minimum tax, he has paid, I think, roughly about $24 million over the last, I think it is actually 17 years, over the last 70, from 2000 to 2017. He's paid AMT. And now what's interesting is he hasn't paid any for the 10 of the last 15. So I'm wondering if he paid most of that AMT in the earliest 3 years that aren't covered by the other one. But regardless, normally, and so my first thought when I heard that, Jason, was, well, depreciation, right? I mean, one of the advantages of being a real estate investor is the concept of depreciation, right? So I buy this building. You can't depreciate the land, but the building itself over 40 years, and that can help shield some of your income. Now, I've never had one of my, and we have a fair number of very successful real estate developers as firm clients. The depreciation does help, but I've never seen it shield somebody's income year after year after year entirely. Right. I mean, the cost of the building over 40 years, I mean, what is that, 2.5%? Most of my clients would want to be making way more than that. So I've never seen one of my own clients just have losses every single year from depreciation. But that was my first thought. What we've since learned is even when you take out the depreciation, most of these have been losing money. Like actual cash dollars, they're losing money.
Yeah, there's some pretty substantial figures, at least, that the Times give. I don't have that directly in front of me, but it was on the order of, from the core businesses, which they really describe as the, several golf courses, and the International Hotel there in DC, something on the order of about $150 million.
150.3. And by the way, that was from the 3 European. He has 15 golf courses, all of which lose money. The 3 European golf courses, the Washington Hotel. Remember the old post office they converted? It's right by the IRS building. In fact, I walked by there a couple of years ago when that renovation was going on. The Doral golf course, which is the one outside of Miami, Doral, Florida, that's his largest, and his real estate servicing company, which makes no sense to me whatsoever. They're all losing $150.3 million from 2010 to 2018. So we have really another 11 golf courses that are also losing money, but just those are losing 150.3 without any factoring in of depreciation. So the losses on paper are even bigger with the depreciation.
And that's, without knowing more, it's difficult to, I guess, explain or make sense of. I mean, you and I have talked about, we don't know the full picture. So there may be rationales that those losses may be expected. They may be part of an overall portfolio or playing a role. You've mentioned that, one of the rationales here may be that they're viewed as kind of loss leaders for a development that was intended to come up around them. We don't know that, but yeah, I mean, the numbers are rather large, and not factoring in depreciation. So it gets to something that's closer to a cash flow or a cash flow stock, and that's quite a bit.
And so here's interesting. One of the lessons I think that you would normally take from this, or if you're listening to the podcast, one of the lessons is, so I told you, we have some real estate developers here who are worth several $100 million. The one thing they will all tell you, if you line them up here on the podcast, is, this is Eric Green speaking. I'm going to say something and then I'll explain. The interesting thing about Donald Trump, and I don't mean this in a negative way, his product, and the only other person I can think of, in fact, you and I and Dan were talking about this, the only other person I can think of that is similar to him would have been Hugh Hefner. And I don't mean that because of the Playboy and scandals and whatnot. What I mean by it is Mr. Trump, his image is the product. And so where I was going is most of my real estate development successful clients will tell you if the numbers don't make sense, they don't give a shit what it looks like. They're not going to go look at the building. When a project is brought to them, they want to see, show me the flow. Give me the numbers. I want to see how this cash flows. And so when they then go to see the building, they know the numbers are going to work. Now that what they're looking for, I've been on several of these with one of my corporate partners. They're like, we don't need storage because we have this other building where we can get 3 more condos. And now what they're looking at is, how do I maximize cash flow? So if someone said to them, yeah, I'm a real estate developer, I've got 15 properties, they lose money every year, but I got 15 of them. They'd be like, are you out of your mind? Why would you be, in fact, and again, one of the other headlines is he's made about 430 million from The Apprentice. Most of that money it seems, according to the New York Times on the returns, has gone to underwrite, float the golf courses. You never want to be investing in a property that is losing money. And I've heard this from new investors, people who I want to get into real estate. And yeah, it loses money every month, but eventually, the mortgage will be paid. It'll be worth something. No. Any real real estate investor will tell you it's got a cash flow. So I'm buying a $2 million building. I'm putting in 20%, let's say. So there's 400,000. I need to be making 40 grand. After all expenses, I want 10%. I want 40 grand, 10 out of that building. All right. And it's about cash flow. It's not so much about the tax return. So what I think, and this is where the New York Times was going, is if you look at, and Jason, let's talk about this. They looked at all of his projects. Trump Tower actually makes money, which is interestingly the first thing he did in Manhattan. The first, when they left Queens and he went into Manhattan for the first time, that was his first big project. That one makes money. The project on the west side that he doesn't control, he's an investor in, but he lost control of, a different real estate developer controls it. That one makes money. And selling his image, like The Apprentice, that makes money. Everything else loses money. All the golf courses lose money. All the other hotels lose money. The Apprentice money is now dried up. That's coming to an end. And he's got these huge loans that he's personally guaranteed north of 400 million. So one of the things that is one of the questions raised is, what does this mean for his image? If he had released his returns and people like you and I and every other accountant and lawyer would be on every news channel talking about them, does this raise an issue of him being this winner, brilliant, billionaire business person?
It raises a real question, and to your point with, the point you're making there originally, I mean, when you look at these and if they are losing money as the Times indicates, I think the point is valid that they certainly could be said to play a role in underscoring that image that he wants to project, right? And so in a sense, he may look at these as an investment that furthers that image. And he is. I mean, Hugh Hefner is a good and interesting analogy to draw, because there's just few people out there that you can think of that literally their business, they are their brand. That's what he's selling. And I think he's unabashedly, I think Trump would say the same thing. I mean, he is a unique brand that is associated with, depending on one's viewpoint, it carries a lot of weight one way or the other. So yeah, it's interesting, but I think, God, as far as the, what people would really be interested in, and unfortunately, I don't think we have, other than the figures from the Times, we don't really have the source of the loans, but I think those are the concerns that raise the specter of conflict of interest and compromised decision making or judgment. And look, it may not be an issue, but it's certainly an unknown right now. And in this particular climate, there's no way that doesn't turn into speculation and questions. And I think the figure, what is it from the Times? I mean, it's something on the order of about $420 million.
Right.
That is apparently coming due within the next 3 years or so, 3 to 4 years, all of that. And so I think the concern you see out there is, well, what's the source of that funding? We know that there's been a little bit of hesitancy from some American lenders in the past to expend that kind of money or extend that kind of money to Mr. Trump. But at the same time, he's clearly, putting the loans aside, clearly he's got access to large amounts of wealth and assets. And what I think you almost have to ask is there enough there? I mean, I wish we had really the true cash flow picture to see, does he really have the ability to service this debt comfortably? Or are we really talking about a set of balloon payments that are about to be coming due that he's personally on the hook for? That's a significant situation, I think, if so. I don't think we know the answers to these, but we apparently do know from the tax returns. And I would expect, if the Times has the tax returns, and they're accurately reported, I guess, that what's on the returns, I would expect that we would know at least an amount, like, at least the amount of debt or liabilities that he's personally on the hook for.
And I want to pick that up more when we talk about the potential conflicts of interest, because like everything, perception is a big deal. It's the perception of impropriety, the perception of a conflict of interest. Whether there is one or not that's impacting him, we don't know. But and we'll go through more facts that really do raise that. I want to go back to the reason I mentioned Hugh Hefner. All right, I'm going to tell you, there are 3 types of taxpayers. All right, there are W-2 employees. They do not get to deduct much, right? They're W-2 employees. Then there are people who live a tax deductible life, who are self-employed, like you and I, right? For instance, my law firm leases my car. I have to pick up a percentage for personal use and report that. But meals and entertainment, a lot of my travel, which is for business, if I can somehow tie in personal, some of that travel can be written off legitimately. My cell phone, the firm pays for. There are things that we get to deduct being, self-employed, but there's personal stuff you and I can't deduct. I can't deduct, my house. I mean, I could argue I have a home office, but it's not my primary office, and I certainly don't meet clients there on a routine basis. So I can't, I don't deduct my home, even though I have a home office. You and I probably spend a lot of time mornings and nights and weekends in our home offices. I'm not deducting it. There's a third category. And I say Hugh Hefner because he got audited and ultimately, I think mostly won, where he was deducting the mansion. He was deducting the parties, the parties at the Playboy Mansion. And he got audited and they said, look, that's all personal. And his argument was no, because what I'm selling is the image. I'm selling the image of the Playboy Mansion, all of the attractive girls around, and on all the famous guests that come. And so it is critical to the image. Mr. Trump is one of those people that's sort of the same. He is the product. So, I mean, how many pictures of them are there in his personal residence? You know, the one that's like all gold. If you like gold, it's great, but otherwise it's a bit, for me, it's a bit much. But he is selling this image of success and being part of a special club and you know, and you know, the high life, for not to grab the Miller, you know, the Miller beer, but you know what I mean? What people perceive as success and wealth, that is his projected image. And so when we get into some of these other things on the returns, the $70,000 for haircuts, a lot of the deductions that he takes, there is sort of an argument for that, like, I can't write off part of my house. I think there's an argument that he can write off part of his because it is in so many photographs and so central to his advertising the product, which is him. All right, being associated with him, which by the way, for those of you who may have been turned off, I don't mean to, but why I'm wondering if he doesn't buy properties, not whereas most people focus on cash flow and business and numbers, he's all about image. I'm wondering if at some point that also isn't influencing some of his decisions that he wants to have, you know, and by the way, and also, can he take over a losing property, slap his name on it, and suddenly have it become a winner because it's associated with him? You know, like you said, we don't know. We weren't in the meeting with he and his advisors on why he decided to do what he did, or it does. But on paper, they are losing money. Now, let's talk about the haircuts, which this is going to sound strange. I don't view that as a big deal. So apparently, he has deducted $70,000 for hair cuts or hair treatment or whatever you're going to do, hair styling, attached to The Apprentice. I mean, I'd love your thoughts. I think it was 8 seasons? Was it 8 or 7 seasons of The Apprentice? 10 episodes in Manhattan to try to get a top line hair person to show up on set and do your hair and be available. That's not a $40 supercuts.
Yeah, he's not getting the same haircut I'm getting, and I wouldn't expect that. I kind of did the math, and it seemed to me like it was somewhere in the ballpark of about $1,000 a haircut or so, maybe even less. It did not, when you put it like that, it didn't really strike me as that extravagant for the situation. I think when you break down the tax issues, there's a clear line between the ability to deduct something that is inherently personal and something that is actually, incurred in the course of reasonably and necessary and ordinary in the course of, one's trade or business. I think this probably would have been a no-brainer had the network, I guess, been paying for the haircuts, which is almost what you would expect. But he was in a partnership with the network, running the Apprentice, and I would suspect there's a haircut before probably every episode, it's one of those things. Look, I honestly don't even view it as a particularly aggressive position. I think they took the position this was not necessarily inherently personal. This was related to his trade or business of being on The Apprentice. And to me, then the question really boils down to, is it a reasonable cost? And there's probably some room for two sides of an argument there, but my guess is if you fight that fight, you get closer to 70,000 than zero.
Yep. No, listen, I mean, I don't know what he's doing to his hair, but I know Hair Club for Men. I have a client that actually told me this. It's about $700 every time he has to go in and have the whole thing treated, done. So if you have to have someone on set throughout the program, fixing and doing and whatever on breaks, I don't know. But it did not, of all the things that they raised, that to me seemed more of a non-issue. What was, and by the way, and what it was more unknown was this. So and this is not unusual, he just lists legal fees. Well, we know Michael Cohen said, and Mr. Trump has affirmed through Rudy Giuliani, the $130,000 payment to Stephanie Clifford, known as Stormy Daniels, was repaid to Michael Cohen. Well, we have a very large number of just legal fees. So what is unknown is what is in that number. If the 130 is in there, that would be an inappropriate deduction, because it's not an ordinary necessary legal expense to pay hush money to a porn star to not talk about your affair during the year of an election. I'm pretty sure no one's going to agree that that's ordinary and necessary. We just don't know if he deducted it or not. Okay. I'm not getting into the campaign finance violations. I'll let New York deal with that. I just, from a tax perspective, it would not be a valid deduction. We don't know if it's buried in there or not. The other thing was the attorney, I don't remember his name.
Cortez, I think.
Yeah, who defended him and then also defended Donald Trump Jr. His fees are listed on the return, but we don't know what they're for. If they were defending the Trump organization in some other criminal issue, that would be valid. If it's defending he and his son in the campaign issue, that wouldn't be ordinary and necessary as a business expense. So again, this is raised by the article. I just don't think we know. We don't have enough information, and without the work papers that went into it, I just don't think we're gonna get there. Let's, just because of time, one thing I do want to mention is Mr. Trump, it appears, ultimately walked away from about, I think it's 280, I'm trying to find the number, $287 million of debt that he either negotiated, or if you want to take the negative approach, that he stuck creditors for. And for most of you, what happens is, if you weren't aware of this, when you borrow money and then don't have to pay it back, you have income called COD, or cancellation of indebtedness. That would normally be picked up as income. Now, there are a bunch of exceptions to that under Code Section 108. All right, we have, Jason, you got bankruptcy, right? If it gets discharged in the context of a bankruptcy, you don't have to pick up the income, because it would, what's the use of getting a fresh start in bankruptcy if you're then going to get whammied for the taxes on it? So bankruptcy, you have insolvency. But then if you're a real estate developer or real estate owner, you have another option, which is you can reduce the basis in your assets to offset. So in essence, you get to kick the can down the road, right? I'm going to reduce the basis so I won't get depreciation deductions. And then later on, I'll have this capital gain when I ultimately sell the property. But even doing all of that, he did have to pick up, I think it's about 100 and something million of it as income, which you can do, I think you can do over 5 years, which he is picking up. So even with that, by the way, he's still losing money, okay? With the COD income factored in of around, I think it's about 56 million a year. He's still losing money. The other thing, Jason, is the audit, right? The 10-year audit.
Yeah. It ties into, I think that's probably one of the things on most people's minds is, what's the status of the audit? What do we know? And it ties into, Erica, really what I kind of think is maybe the most interesting tax issue in the whole thing is what appears to have been a loss that was claimed or taken with respect to divesting himself of his interests in the Atlantic City casinos that his organization controlled. And I think that is, I don't know, all signs from what I took away from the article and what the focus was, all signs seem to indicate to me that is actually probably the source of the audit and the negotiations that have been going on. But in a nutshell, what looks like it happened there is back in 2009, and at that point in time, the organization, the organization holding his interests in the Atlantic City casinos had been through kind of several rounds of bankruptcy proceedings. I think we're on the cusp at that point of additional proceedings coming in. And one of the things that's threatened there is that Mr. Trump is not going to be really in control of them at that point. And so he informs the SEC through very carefully, correctly crafted language, I guess, that he was basically abandoning his interests in those. The significance of that from a tax perspective is the tax code provides that where a taxpayer abandons, and it has to be a complete abandonment, but abandons a worthless security or a worthless investment here, that it will be, they will be entitled to take an ordinary loss. That means they would be able to take the loss on that investment or venture against their ordinary income, which is subject to the highest tax rate. And that's basically the best kind of loss from a tax perspective. Now, the issue or the other side of this is if one does not actually completely abandon the investment, or they actually receive something in exchange for it, then they're treated as having, and this is the language of the code, but a sell or exchange of that capital asset. That triggers either a capital gain or a capital loss. In this situation, it would have been a capital loss. The problem with those is the code doesn't allow you to just deduct them or freely deduct them. There are existing capital gains and then up to $3,000 a year, which would have been fairly meaningless in President Trump's situation. And so the issue appears to be there was about according to the Times, there was about a $700 million loss taken in 2009. And it was actually as a result of tax laws that were signed into law by President Obama at the time. Mr. Trump then was allowed several prior years, which happened to be years when he made about $450 million as a result of The Apprentice and various licensing relationships. And so was able to take that loss and offset that. Now, I think, assuming all of the numbers are right, which you can dig into separately, and I'll just take it at face value that the numbers are right. Assuming that, I think that's largely the correct treatment if there is or if there was an abandonment of the Atlantic City casinos. The problem or the issue that gets infused into this is as a result of the bankruptcy proceedings, it appears that President Trump actually received a 5% interest in the successor entities that came out of that bankruptcy. And look, there were apparently reasons why various parties actually wanted him to have an interest, because his name is marketable, goes back to much of what we were talking about, is marketable and carries value. And so, but from the tax perspective, if he received a 5% interest in that successor entity, well, then there wasn't there wasn't a complete abandonment of the venture, that creates a problem and appears to be the source of the issue or disagreement with the IRS or with the government. I'll shed some light on that in just a second. But if there wasn't a complete divestment or abandonment, then he wouldn't be entitled to that deduction, and he would basically just have to carry his basis in that new venture forward, or would have had to recognize a loss at the point in time that it was transformed into a successor entity. And then the complexities with the ongoing audit or ongoing dispute, it appears, again, they arise out of that. If the numbers are correct, it kind of implies that there's about roughly $100 million plus at issue. There's about a $72 million refund claim that apparently the IRS or Treasury actually cut to him whenever he originally made the refund request. And it goes through a process where the IRS kind of follows up on that and has apparently raised questions about whether it was valid or not, or should have been issued. And when you have a refund of that size, generally there's an additional requirement besides the IRS just going through and okaying and issuing the refund. There's an additional requirement that an entity or group known as the Joint Committee of Taxation, which is in theory at least a kind of a bipartisan group that employs a number of non-political, more career types, but does employ quite a bit of actual substantive tax knowledge and tax lawyers and the type. And the Joint Committee on Taxation generally has to approve of the refund. And it appears here that there's been for quite a number of years an ongoing back and forth negotiation or set of disputes. And it looks like it's all or mainly centered on this deduction related to the Atlantic City casinos. And as best I can tell from what the New York Times has reported, it remains in that limbo right now.
And what's interesting about it is, why is it taking so long? The hint being, are the Republicans who are in control sitting on it and allowing it to sit and collect dust? Because I don't know about you, I've never seen one go 4 years.
No, I haven't either. I think it is. I think any tax professional that's dealt with this would have to tell you it's incredibly unusual that it's taken this long. I don't know what inference to draw from that, but it's certainly unusual.
Right. The other thing, and just because for time purposes, one of the other things raised, and I'm going to kind of skim over it because it's interesting. I think I have a guess as to why it's happening. On many of his foreign deals, it appears 20%, and it's always 20% of the deal is paid for consulting fees with no breakdown. However, what the New York Times did notice, like for instance, one of those fees was $752,000. In her disclosure in the White House, Ivanka Trump, because she is an advisor to her dad, she has to do her own disclosures, disclosed that she picked up $752,000 of consulting income. And in putting that together, what the Times has sort of guessed is these consulting fees are going to his children, who, when they called people involved in the project, this one happened to be in Turkey, the 752,000 or whatever, said they never dealt with Ivanka Trump, and they don't know, as far as they were aware, she was not involved in the project. So, of course, the Times raises the issue of, well, why is he doing this? You know, is this ordinary and necessary? My guess is that it's probably a way for him to shift income to his kids. Partially, could be part of his estate planning, right? To just kind of shift it to them. And in doing so this way, he doesn't have the payroll taxes. They can deduct expenses against it. They would still have to pick it up subject to self-employment tax, theoretically. So he's shifting the tax burden from himself to his kids, but they do get to deduct their lives, theoretically, against it. But in getting into that, and we started to talk about this before with the potential conflict of interest. We have this debt, right? We have this $420 million that's going to be coming due. What the New York Times article points out is when Mr. Trump became a candidate for office, all of a sudden, all of his clubs, all of his hotels for as far as events suddenly got much busier, right? Now, to be honest, I don't think that's surprising. All right. I'll be honest, I think if I ran for president, became the Republican nominee or Democratic, doesn't matter, nominee for president, I'm willing to bet Green and Sklar, my law firm, would probably become a lot more popular. All right. Just because clients, you know, if nothing else, think my partners have an in with the president, or maybe they want to be at Mar-a-Lago to see the president. I don't think any of that, there's nothing nefarious about that. What is interesting, though, is how many lobbying groups and pressure groups suddenly began moving their events to Mr. Trump's entities, allowing him to, I think he's making like an additional $7 million a year now, they pointed out, at a Mar-a-Lago because of that, which does give rise to, and again, whether there's a conflict of interest, we don't know, but it's the perception of it. The hotel in Turkey, when things were good, not just private groups, but Turkish government entities began booking their events at the Trump Hotel. When we had that sour falling out with Turkey, they canceled all their events. After he made up with Turkey and allowed them to go into northern Syria, whatever, they suddenly rebooked all their events at the Trump, resort. So, is it really a stretch to think, or wonder, is our foreign policy for sale? We don't know. You and I aren't in the room. I don't know what deals he's cutting. It may mean nothing at all. He may be independently making his own decisions, but it does. And this is the problem with only having it in the revocable trust and still having an interest and still getting money from them. Is this idea that he's not really independent. And because of that, it's the perception of it. Whether or not he is or isn't is impossible to know, at least from where I'm sitting.
Yeah, I think that's right. And, I think it's clearly the implication that the Times is putting out there, is to draw that, I think is to draw that implication from it. I think the truth is we don't have enough information, and I suspect that, there's a portion of the country that's going to draw a conclusion they're going to draw regardless, and there's another portion that's going to draw a very different conclusion kind of regardless. Mm-hmm. But I do think, whatever it is, and I think, neither of us are here to tell anybody listening what that is that they should draw from it, but I do think you should have all the facts, and I do think you should know these. And look, you gotta make your own deductions from them and decide whether these are concerning facts or whether they're not, or whether this is just the way our political, geopolitical, economic system just works. There's an argument to be made. That's just how it is. But there are certainly certainly from what they've laid out, there are some circumstances that I think some people would be concerned about. And again, some are going to perhaps find those circumstances to be helpful or not concerning.
And the last thing before we have run out of time, we started talking about this, the New York Westchester County estate. And the reason is the Times article came out, we did the webinar, and I believe it was the next day or that night is when the Wall Street Journal reported that New York State was looking at that as another affirmative act in a potential criminal case against him. So what this is background, is Mr. Trump purchased an estate. Is it Silver Springs? I don't remember what the name of it is.
Springs, I think.
Yeah, it's in Westchester, which is, for those of you not from this area of the country, it's north of New York City. Lovely country up there. Apple picking, it's really, it's parts of it are very rural. He bought this, and if you can Google it online, it's not like a little country home. It looks like a castle. I mean, it is huge. His goal was to develop a golf course, and does this ring a bell? We'll do a golf course. We're going to do houses around the golf course. The neighbors up there fought it over the zoning because it would cause a traffic nightmare up there. The roads are not designed for that, and ultimately the neighbors blocked it. So at that point, Mr. Trump now can't develop this, but he has all of this wooded real estate as a tax planning tool, and I don't believe there's anything wrong with it. He actually creates a conservation easement, which is where he goes to these towns in New York and says, look, I am going to put a conservation easement on this. I will not develop it. It'll remain wooded open land. For the most part, at least up in the Northeast, we tend to think of this as a good thing, right, to preserve open land and wooded areas and whatnot, which now is for him a huge charitable deduction, and he gets a $21 million charitable deduction for this. I don't see anything wrong with that. I think he's entitled to do it. He did it. Nothing strikes me as wrong. Here's where it gets interesting. He then, the next year, I think it's 2015, begins writing it off as a business property. It's an investment property. So he's depreciating it, taking business deductions on it, all that. Except there is no business. It's not for rent. You can't, you and I couldn't book it for a conference. And all of the public statements by his children it's a personal retreat for the Trump family only. Well, again, this gets into one of these, if it's personal, he should not be deducting it, right? And again, as far as I'm aware, and I do not follow everything that Mr. Trump does or President Trump does, just for my own sanity, I don't know that he's ever used it in his advertising. I don't know for certain that it's not available to the public. I've gone and done some searching. I can't find anything. So I don't believe it's open to the public. So it raises the issue of why is he deducting it, which to me would seem just as a very aggressive tax position. It seems that New York State is looking at it as way crossing the line tax position, which again, they may be using as a pattern of abuse. Again, I don't know what New York is doing, but I found it interesting that we spoke about it, and then literally the Wall Street Journal article came out mentioning that estate is one of the things New York State in its criminal case is looking at very closely.
It's going to be an interesting few months, it appears.
Interesting is one thing. I hope it doesn't get too crazy. That the world doesn't end on November 4th. So listen, Jason, thanks for doing this with me.
Yeah, thank you as well. And enjoyed it. Crazy thing is there's almost another episode here because there's still a lot to talk about. And it appears there will continue to be fodder in the coming days and weeks as stories develop. But yeah, no, really enjoyed it. Very insightful. Appreciate all of your insights on this. And who knows, we may have to come back and do a follow-up here in the next few weeks.
We'll see. We'll just keep watching the headlines. And for those of you listening to this, hopefully you feel we were being even-handed. I think, first of all, I think there are some good lessons to take from this. I mean, it does highlight the idea of real estate investing and depreciation and what is deductible and not deductible. And the truth is where you cross the line, like haircuts for me, not deductible. Haircuts for somebody who's part of the image, probably deductible to an extent. And so I think the article raises a lot of interesting issues. I think it is worth certainly looking at, and you know, maybe you'll come to your own opinions. The New York Times opinion is barely disguised, but thanks for listening. And Jason, like I said, thank you for doing this. And yeah, maybe we'll be doing a follow up in 2 weeks or a month. You know, so listen, thank you, and thank everyone for listening. And listen, have a good day.